Welcome everyone to Vested Interest. This is Shane back for a stock pick of the day video. We are going to take a look at another one out of the information technology sector, another software company here, Oracle. This is the Vested Interest stock screener. This is the criteria we will be running through in this video. It must meet 5 of 8 to make it onto my watch list. If it does make it onto my watch list, that does not necessarily mean I am buying. It just means out of the thousands of companies in there, it met the initial screener, and I want to do more of a deep dive into the financials of the company where there's some other criteria that it must meet for me to be interested in buying in the future after I do a discounted cash flow analysis. And then maybe if I'm adding a new position or swapping out of positions, I might add it in the future. So just because it makes it on my watch list, don't run out and buy it. That does not mean that I am buying. It doesn't mean you should buy. And you should not be blindly buying or following anything that anyone does on YouTube that you really do not know. All right, back to Oracle. You can check them out on their homepage, www.oracle.com, www.oracle.com. That is where I pulled this information from. And as I mentioned before, they offer a lot of software and cloud infrastructure, so complete cloud infrastructure and platform services for every workload. OCI offers a common set of 150 plus cloud services in each cloud region. Get all of the services you need, from containers and VMware to AI, to migrate, modernize, build, and scale your IT. Automate all your workloads, including both existing and new applications and data platforms. So some of the services that they offer: AI and machine learning, analytics, billing and cost management. So for your HR department who does your billing, compute database services, developer services, distributed cloud and multi-cloud, governance and administration. So there's some more administration services they offer. Identity and security, so logon securities, integration, migration if you're trying to move data from one to a system to another, and disaster recovery services if you want a place to store in the cloud your information to where you can recover it later if you had a network failure or something like that. Network and connectivity, observability and management, and storage. Obviously, with their cloud service, they offer a lot of storage capability. Now, the reason we're taking a look at them, down 3.79% on the day, we are talking about Oracle Corporation, ticker ORCL, out of the information technology sector. We have looked at this maybe a couple years ago. They closed out the day at $244.24, 52-week range as low as $118.86, as high as $260.87. They are much closer to their 52-week high than their 52-week low, not even close to within 15% right now, even with the drop today. Market cap of $686.028 billion, a beta of 1.43, so they are more volatile than the overall market, right? You can possibly use that volatility to your advantage, buying them whenever they dip down significantly, holding them on their way up. PE ratio, price to earnings, pretty high for even a tech company, $56.14 per share, 56.14. That is pretty high. Again, even for a tech company, they've got to be growing extremely fast to justify that. Got to be growing their earnings pretty fast. Earnings per share, EPS at $4.34. Earnings date, September 8th, so we will see that a little, not quite a month away. Forward dividend is $2. They are quarterly payers, so divide by 4, though we'll see that here towards the end of the video. Dividend yield starting at 0.79% if you were to buy them now. Ex-dividend date, July 10th. Looks like they paid out on the 24th, so we are past that. So you would be in line for the next dividend if you bought them now, but you're going to have to wait a couple months to get it. Jumping over to the right, I like to look at dividend yield theory to see if the company is potentially undervalued. To do that, we look at their 5-year dividend yield average, 1.36%. We compare that to their current 0.79 over here where it says forward annual. It's their current 0.79, same number. Since it is lower than their 5-year average, that actually speaks to overvaluation right now, at least according to dividend yield theory. Payout ratio is pretty low on this one, 39.17%. Looking down here at free cash flow, I want growing free cash flow over time. Because companies can do some things with that free cash flow. They can pay down debt, make acquisitions, reinvest back into the company, carry some of it on their balance sheet as cash for a rainy day, buy back shares, which it looks like this company is doing, pay a dividend or raise that dividend over time. We want a company to be able to do all of that, so we want that free cash flow to be growing. Going back here in time, looking at May 2022, $5 billion, a little over $5 billion in free cash flow. 2023, 8.4, so a raise there. May 2024 up to 11.8. So first 3 years, they're definitely growing. 2025, though we're not quite through with the year, it looks like we're actually going to see a downturn here, negative 394 million. So unless they really turn this around over the last 4 months or so, It looks like we might see a negative. Now, repurchase of capital shares, same thing. They've dropped off on their repurchase of shares, 17 billion in 2022, 2023 down slightly, 2.5, back up in 2024, 3.2, looks like 1.5 million, so, or 1.5 billion. So unless they increase their repurchase of shares or start growing their free cash flow, it actually looks like a downturn in 2025. So I wouldn't give them growing free cash flow over the last 4 years, at least not in 2025 here. Jumping over to stockanalysis.com, this is another source I go to for information. It is just one of the 2 or 3 sources that I use, Yahoo Finance being another one. You pick any sources that you want, but I do recommend you look at 2, if not 3 sources, especially if you see conflicting data. And that's when I'd go to a third source so that you can make sure the information you are looking at is accurate and up to date. Now, they do have 27 analysts that have looked at this. They call it a consensus buy, low estimate of $165. That would represent a 32.1% decrease from where it currently sits. Average estimate of $228, which would be still lower than where they currently sit, and that would be a 6.16% decrease from where they currently sit. And only if it hit their high of $325 estimate would you see any upside of 33.73 potential upside there. Looking at statistics, I like to look at return on capital employed as initial metric, and I like 10% or better. They're at 13.23%, so a little lower than I'd like them, but it is above the 10% I'm looking for. EPS growth is over the 5% I'm looking for at 27.81%, and revenue growth pretty fast at 16.7% forecasted. So maybe their revenue is growing fast enough to justify that 50 plus PE, but it's got to be growing earnings needs to be growing pretty fast. In revenue, you want to see how much of their revenue they're actually keeping, right? Revenue growing is nice, but how much of the revenue are they actually keeping versus paying down debt, making acquisitions, buying back shares, doing all the other things they can do with that. All right, looking at their dividend history, quarterly payers we mentioned. Now, this is where you see there's a little discrepancy. Stockanalysis.com has their payout ratio at 41.47. Now, it's not that far off the 39% that we saw with Yahoo Finance, but it still is a discrepancy. So you might want to look for a third source and see which one is accurate. Either way, it's well under the 75% that I look for. Dividend growth of 12.5%, double-digit dividend growth, nice to see, especially with a payout ratio in the 39 to 41% range. Growth of 11 years, buyback yield is negative. That means they are not pulling more shares out of the market than they are issuing. We do not like that, or I do not like that. I want them to be buying back more shares than they're issuing. We'd like to see this turn into a positive. Shareholder yield is negative as well. That's not good either. We want this to be positive. Now, they do pay off schedule most companies, January, April, July, October timeframe. So I do like that. Helps to average out. If you're going to try to live off dividends in retirement, this will help average them out if you get companies that pay on different payout months. And I try to do that in my portfolio. Going back in time here, January 2023, they're paying 32 cents. Raised that up April 2023 to 40 cents. Looks like they actually froze it all of 2023 after that, and then in 2024. So I don't know if I agree. They didn't raise it in 2024. I don't know if I agree they had 11 years of growth. Looks like they didn't raise it in 2024. Still 40, 40, 40. The next raise was April of 2025. So it looks like they actually froze their dividend in 2024 and then started their raise again here in 2025. So might be something to keep an eye on. Looks like they may pause the dividend from time to time, like 20 April, yeah, all through 2024, no raise. So, yep, looks like they paused it during 2024. Back raising it again here in 2025, though. All right, understand the business again. They are a software provider. They offer a lot of different software applications for your back of house, your HR, your bill paying, as well as storage options. Mitigation options, migration options, recovery, data logon security, that sort of company. So they have their hands in a lot of IT related software that your company may be using. I think my company uses Oracle. I'm pretty sure we use it for a secure logon. Growing free cash flow. No, I'd actually say it's downturn in 2025. Growing dividend. Yes. Dividend pay ratio is well under 75%, around 40%. Dividend yield theory says they're potentially overvalued, so no check there. It is not within 15% of a 52-week low or even close, really. It does have a return on capital employed above 10%, so check there. Earnings per share growth forecasted well above 5%, actually above 27%. So 1, 2, 3, 4, 5. It barely makes it onto my watch list. 5 of 8 there. Might be one to take a look at. And again, I would love it further down, closer to 15% of its 52-week low. If I was interested in this company, even if the metrics look good, I would probably wait for that pullback down into that range again. Well, let me know what you think of Oracle in the comment section down below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Drop a comment down below. Let me know what you think of the video. Let me know what you think of Oracle. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Oracle you'd like me to cover in the Stock Pick of the Day series, drop it down there. I'll work it into the rotation on a day it pulls back. I still have UPS to cover on a day it pulls back, maybe tomorrow if it does. But this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. You can read the rest of this. And for those of you who made it to the end, thank you for watching. Watch time is one of the metrics that the YouTube algorithm looks at. And if you know anyone who is a dividend investor or an investor in general and might like the content, make sure you share the videos with them. Thank you.